We live in a world right now which is filled with a lot of bad news, whether it is market or war or inflation or rate hikes. But let me start off by telling you something which made me very happy. Thanks to you, we today have over 2,000 subscribers. I really appreciate and thank you for taking your time out and subscribing to this channel. I'll try and strive even harder to make this channel worth it. In general, I don't see my phone on Sundays. I want to give it a break and I also want to take a break from itself. And when I open on Monday, I generally see about 10, 12 messages from clients and friends and family. But this Monday, it was different. I had over 13 messages from my investors and clients. They were asking me questions like, should I be investing more? Should I exit the market and enter back in the next 2, 3 weeks? Should I exit out all and wait for a year? There are a lot of these kind of questions that I generally don't get to see. Now, if an investor of mine has this question, this may be on your mind too. Therefore, in this video, I thought I'll share something interesting with you, which I had shared with a couple of my clients very recently. Please do watch till the end. What should you be doing in the current market situation? You can either buy, you can either hold or redeem. These are the three primary options that you have. So I try and cover all these points and our views for the next 1 year. Our Indian markets have had a great run in the last 2 years. We are one of the best performing markets across the globe. But yes, the start of this year has not got us any good news. The indices, Nifty is down about 9 odd percent, while the junior is down about 11%. The key reasons, as we all know by now, are inflation and rate hike, which has triggered the market correction in Indian markets too. Let's forget the other global markets, especially US and Nasdaq, and also cryptocurrency. While I continue to believe that the India's growth story is very intact, but the expectation that we all had on the GDP numbers has to be tapered down, right? Indian GDP will definitely come down if this inflation persists and the rate hike starts pretty early. One interesting observation in this is that you see that, okay, the market is down only 9%. Why is your portfolio down far more than that? It's primarily because you would have invested in overvalued sectors. Take, for example, Nifty IT here. It is down 23%. Look at small cap, it is down close to 23%. Look at Nifty Pharma, it is down 12-13% only. What I'm trying to say here is that sector rotation is a key thing in a portfolio, and if you don't do that, you may get stuck with overvalued sectors that can pull down your portfolio. I remember telling my investors about small cap being overvalued in the month of Feb 2022. Similarly, I was always very negative about IT for close to 6 months, if not more, and very positive about banks. It's another thing that the banks have also corrected, but relatively, we are better off. Put it in a nutshell, the markets have corrected well ahead in expectation of the correction in GDP number. There is PE multiple and then there is EPS. These are the only two major contributors to market returns. While there's no clear trend, to be honest, but the analysis that we have done generally says that the PE multiple generally re-rates before any big EPS growth. It can go up or go down. Over the past few years, the PE multiple has ranged anywhere between 12 to 27. In 2008, it was close to 12 and it did touch 27 after a few years. But now, post the stable government, it is stabilized around 23, 24, 22 levels. The expectation is that India's EPS growth, the large cap EPS growth, is expected to be in the range of about 20% for the next year and 13% for FY24. But we all know now that there is a possibility of big downside to this estimate. Let's keep that in mind for now. We did another set of analysis to figure out what contributed to Nifty's return. Is it only PE rate re-rating? Is it only EPS contribution, or is it both? So if you go back to history, you would see that there are negative years, and in those negative years, the contribution of PE re-rating is huge. This is primarily because EPS correction is around the corner, and before that could come in, PE already re-rates itself by a significant margin. Take, for example, the first year of 2009. PE re-rating is to the tune of 33, right? And if you see 2012, while there was an EPS growth, PE re-rated by 15, the same applies in 2022. The PE derated by 22 points. The final analysis is that while the PE re-rating can happen if the EPS growth is there, the particular asset that you're investing in should continuously grow, and over a period of time, market should start giving you higher PE multiples. So this is where my analysis is. I just did a back of the envelope calculation, and don't catch me if things go wrong. As I said earlier, the estimated EPS growth was about 20 for the year 2023 and 13 for the year 2024. So the EPS was expected to be, EPS as you know stands for earnings per share, was expected to stand at 875 and 990, right? What we did was we said, okay, let's re-rate it by 20%. EPS revision worked out to 847 and 935 for the year 23 and 24. Now, if you do a severe bit of an EPS correction, it is coming out to 818 and 882 for the year 23 and 24. We all know that the PE multiple by now is about 23. I thought, why don't we put an 8 to 16% downside to it? So it worked out to 21 and 19. Let's assume that nothing changes. You continue to earn the same EPS and you continue to enjoy the same PE multiple. That would mean that from the current levels, Nifty itself should give you 27%. This is absolute returns. And the 2-year return should be about 37%. This is the best case scenario if everything is as per the earlier estimate. The current scenario where there is a bit of a derating, re-rating, everything is happening around us, I think we should expect about 13% return. But let's now look at two other situations. The worst case looks like we should be around 16,555, which is about 4.8% return from the current levels. And if there is a heavy downside over the next 1 year, if we go by these calculations, the Nifty multiple, Nifty can be very flat, right? In our opinion, even if you look at worst case scenario or heavy downside, you don't see a huge value correction, but definitely time correction. So for all you know, you may not make returns and you may see some downside, but it should quickly recover back. In the end, I think you should expect anywhere between 4 to 5% return to about 13% return in the next 1 year or so, provided you enter at these levels. So what should you be doing? Should you invest, hold, or redeem? If the war situation changes for good, then the markets can rally very quickly. After all, the market is down because of inflation, and if things that are creating the inflation are getting better, then it would mean that the market can also grow very fast. So I would not suggest you to exit your current portfolio. What you can always do is exit out of overvalued sectors and segments and get into something which is far more attractive. Look at the PE multiple, look at the other variables which contributes to the growth in Nifty stocks. So please be wary of investing in overvalued sectors and try and get your money into undervalued sectors. And to answer your question on redeeming, I think that is out of question. And if you want to invest more, maybe start just dipping in. Put in about 10-15% of the investment that you plan to do now. Just see if the market corrects further, then you can add more, or if it shows signs of stability, then definitely you should add more. So net, I don't think redemption is an option. You may look at buying more and definitely keep your existing portfolio, provided it is not into the overvalued sectors, intact. Hope you like this video. Please do share your feedback and comments. Good luck and happy investing.